This is MacroVoices with hedge fund manager Eric Townsend, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Let's move on now, Patrick, to this week's Postgame chart deck. Listeners, you'll find the download link in your Research Roundup email. If you don't have a Research Roundup email, just go to our homepage, MacroVoices.com. Look for the red button that says Looking for the Downloads. Patrick, the chart deck is titled Bond Carnage in Macroland. What's going on here?
We'll get to the bonds at the end of the chart book, but let me just quickly take all of our listeners through a couple things going on. Now, one thing that I was highlighting over the last 2-3 weeks was essentially that after you have a 500 S&P point rally in a span of a couple of weeks, inevitably some sort of mean reverting correction is just natural for the markets. That's the way they behave, the things they do. To me, the big question here is that will we see this behave as though it is this type of a correction, or is it going to turn into something more ominous and the selling starts breaking key levels? For me, this very level where we're trading near this 44.50 level is a point of high interest to me, but then some pretty good supports come in around 43.20 and 4400. My first inclination is that we should get a stock market bullet bounce up. Whether that makes a higher high, whether the market is going to have another bull leg, is the jury's still out, and I'm not sure I want to stick my neck out. But I think that the bigger market sell-off that the market is vulnerable to is likely still maybe a sell in May and go away window, and that it may not emerge in April in this time frame. But we'll call the play-by-play here on the show each week. But going on, I wanted to just touch on page 3 to the euro, because what's interesting to me is that the dollar index has broken to a higher high. We've talked about it at the beginning market wrap of how strong the dollar has been. But what's interesting is that whether you look at this euro USD, which has not broken to a lower low, the pound sterling hasn't broken to a lower low, and the yen, while the US dollar yen has been rallying, it hasn't made a higher high yet. And so while the dollar index has broken out, the three of the majors inside the basket have, to me, not confirmed. I really want to see whether some of these currencies start to break to lower lows to really validate that next move in the dollar. Moving on, though, Eric, to page 4, I have crude oil, and I wanted to share my view with you and see whether or not this kind of plays out in your mind. So to me, if the bulls were going to keep control of the short-term trend, because I also agree a lot with your view that the big picture still has plenty of room for crude oil to go to higher prices. The big question in my mind is the short-term trend going to be a continuation higher, or are we going to spend time just backfilling and retracing that incredibly overbought short-term state? And really, with now the last week or two where crude oil has failed to follow through on any rallies and now under 100, I think it increases the likelihood that the next couple weeks, if not month, is just going to be a lot of chop. Maybe I don't think we're going to see much time, let's say, below 90 on any sustained basis. So it probably is very close to the bottom end of its ranges. But my view is sort of that this could be just grinding here for weeks before something more bullish starts to emerge on the chart. Would that fit in with your narrative at all?
My view is very similar to that, Patrick. I think we've already sold off down to kind of fair value. If you look before the whole Ukraine-Russia thing blew up there in the chart starting at the beginning of March, you just extend that trend that was already in play. We're back down to that trend line that was already there. So we've already, basically taken the war pricing mostly out of the market. I still think, though, that what we're seeing in the technicals suggests that what's going to happen is the market is going to continue to grind and churn lower, not crashing, but just continuing to grind lower until something happens. and something happens, I mean geopolitically, when there's new news or a change in this. Now, if there was actually an outright, we've come to a new global peace accord. Everybody agrees that not only is the Russia and Ukraine conflict over, but World War III is over, and everybody has agreed to a new arms limitation treaty, and everything is wonderful. Oil's going probably quite a bit lower on that news. I don't think it's going to happen. I think it's a question of time until we get news in the opposite direction. But speaking of energy futures, Patrick, let's move on to page 5 and uranium. Boy, looking at the Sprott Uranium Trust as a proxy for uranium prices, looks like we're hitting a cycle high.
Oh, yeah. And what's interesting is nat gas has been also incredibly strong as well. But this trend has just been so strong, higher highs, higher lows, working its way to a major overhead resistance. And then this week we got the breakout. Uranium is working, and it continues to be a place where money is flowing. Now, I don't know whether this is the moment to go and start putting brand new positions to work. It's sort of like if you weren't in the uranium story over the last month or two, it's the kind of the bus has left the station without you. But it's definitely a bull breakout that on the short term can tack on $1 or $2 more on the upside and continues to be very bullish. But Eric, what I really did want to talk about, because Bill inspired me when I was listening to the interview, just talking about bonds, to just really touch on what is going on here. And instead of looking at the yields, I wanted to just kind of turn those charts upside down and actually look at the notes and bonds themselves, in not only the U.S. Treasury, but what's happening around the world. And what we continue to see is these bonds are being crushed. Obviously, the dot plots are moving. Everyone knows that Fed is going to move on these interest rates, and inflation's running hot. A perfect recipe for weak bonds. But it's actually amazing the magnitude and speed of the drops that we're seeing, whether it's the 2-year, 5-year, 10-year, or the 30-year that we have on those pages. It's just getting really ugly. And what's a little bit surprising to me, Eric, is that I would have thought that the stock market would have cared more about this. And it just seemed over the last many weeks that the stock market kind of is almost marching to the beat of its own drum and not noticing this. But inevitably, valuations start to substantially go up when on a relative basis when these kind of moves in interest rates and yields are occurring. And I'm certainly curious when the stock market is going to start to care.
Well, usually when stocks and bonds don't agree, bonds have a pretty good track record of being right.
Yeah, absolutely. I wanted to just touch on the last two charts on page 10 and 11. Just what an extraordinary move on German bonds. We went from a negative 60 basis point yield to now being at a positive 70 basis point. And again, obviously it's under 1%, and everyone kind of can easily roll their eyes on that's not going to have that big of an impact on the markets. But I think that it's a big shift in sentiment, because we were stuck in that disinflationary period where negative yields were just something that could be a reality. But it's most of the world is now entering the positive yield, and I'm kind of asking that question as to whether negative interest rates are now a thing of the past, where we look back in the history books and talk about that window for a half decade where we saw just such deep negative interest rates, and will we ever see it again?
Well, Patrick, I think that is the gazillion-dollar question: is did we see already the peak in the bond market, the final top and the end of the 37-year, is it, bull market in bonds? Seems like the signs are getting pretty strong that maybe we did. Listeners, if you enjoy Patrick's chart decks, be sure to try out a free trial of Big Picture Trading, Patrick's service. You'll be able to get Patrick's chart decks every single day of the week with his webinar service. You can find the information on page 12 or at bigpicturetrading.com.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com. the Internet's premier source of online education for traders. Please visit bigpicturetrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the Internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at MacroVoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.